Right, part 3, let's take a look at the financial. So if we look at all of the transactions we did in part 1 and 2, we have our statement of cash flows items, our balance sheet items, and our income statement items. So we're going to use our summary of transactions to put together the financial statement. So our income statement, you see at the top, fees earned, which is our revenue, $12,350. We add up all of our operating expenses, and we get total operating expenses of $6,320. We get operating income of $6,030. And then we have a new section, we have other income, rent revenue of $360. The reason this is because the word operating income means your income from ongoing operations. So the ongoing operations and the principal way of business for family health care is the revenue and expenses they earn and incur for doing healthcare services. The rent revenue that we earned on is just something we do on the side to make money. So we break that out separately from the revenue and expenses from ongoing operations. So we have our operating income is $6,030. That's from the medical practice that we have. And then we had other income from the rental stuff that we did on the side to get the total net income of $6,390. Retained earnings statement. If we take beginning retained earnings, we add net income that we just calculated on the income statement, subtract dividends, we get ending retained earnings of $8,510. Our balance sheet, we add up our assets first. One thing to point out is under office equipment, you see we have office equipment at $8,500, which was at cost. Then we subtract accumulated depreciation of $160. Remember, accumulated depreciation is an asset with a negative balance, so we subtract it. And for our equipment, we then get $8,340, which is called the book value. Book value is cost less accumulated depreciation. So our asset balance is $38,110. Then we add up our liabilities and stockholders' equity. We get $38,110, so our balance sheet ties out. So our statement of cash flows, we break out our operating activities, investing activities, and financing activities, and we find out our net increase of cash is $410. Our beginning cash balance was $7,320. So if we add the beginning balance plus our increase in cash, we get an ending cash balance of $7,730, which also ties out to the cash balance that we show on our balance sheet. So if we look at the integration of the financial statements, we look at our statement of cash flows, we calculate ending cash of $7,730. That equals our cash balance on our balance sheet. If we look at our net income of $6,390, see how it flows over into the retained earnings statement, added to the beginning balance of retained earnings, subtract dividends to get ending retained earnings of $8,510, which is brought up to our balance sheet in the stockholders' equity section. So let's take a look at why we use the accrual basis of accounting. So let's look at cash versus accrual accounting. Let me first say that accrual accounting is the only method of accounting acceptable for GAAP. So cash basis is sometimes used very rarely for very small businesses, but in this course we will be focusing on the accrual basis of accounting. So if we look at the differences, cash basis accounting, revenue is recorded when cash is received, when you get paid. So if you do work in June and you get paid in September, under the cash basis you recognize revenue in September when you get paid. Same with expenses. If you get your electric bill in June and you pay it in September, you recognize the expense in September. And there's no adjusting entries needed. Remember our accrual basis, which is what we've been doing all along, revenue's earned, revenue's recognized when it's earned. So Joe does lawn work in June, gets paid in July, revenue is recognized in June. Same with expenses. Expenses is incurred in the same period of when they generated the revenue. So Joe does lawn work in June. He buys fuel from Mobil in June to mow those lawns. He would recognize the revenue for the fuel in June to match the revenue. So the expenses match the revenue. And adjusting entries are needed in accrual basis accounting to prepare financial statements. So accrual-based accounting is a more accurate measure of the company's performance. That's because you see the revenue and the associated expense in the same period, so you can make a good judgment. So if we look at Joe's lawn service, we see the revenue that he earned in June. We would see the expenses he incurred in June to earn that revenue, and you get a really good picture of the business. So the accounting cycle. What we've been doing all along this far is our first step, we identify transactions. Family health care took care of some patients. They prepaid insurance. We're identifying the transactions as step one. Step two is to record them. So cash goes up, prepaid insurance goes up, recording the transactions. And then we record adjustments. That would be prepaid insurance expires, recording depreciation, accruing wages earned. And then finally, our last step is preparing the financial statements, our income statement, our retained earnings statement, our statement of cash flows, and our balance sheet. That's known as the accounting cycle. And that's the end of the chapter.